tax rates change, tax rules change, legislation changes on a constant basis, and your investment returns will change. Hopefully they go up, maybe they go down, but that's always going to impact a retirement plan.
Welcome to Steadyhand's Coffee Break video series, where we share insights to help you, our Canadian clients and friends, navigate your financial future with confidence. Now, having worked with thousands of Canadians, we believe retirement planning and investing should be empowering, not overwhelming. So thank you for joining us today as we look at the key retirement and investment numbers for 2025. And of note, any of the calculators or blogs that I or Owen refer to in the following comments will be available in the video notes that accompany this video. Let's get started with the 2025 updates to some key investment accounts. And we'll begin with the amazing TFSA. This year, you can contribute up to $7,000 to your tax-free savings account, which is the same as last year. If you've been eligible since the beginning, which is to say that you were 18 years or older in 2009, your total lifetime contribution room is now $102,000. That's $102,000. Now, as I hope you'll appreciate, TFSAs offer incredible tax advantages, especially if you're using the account for investing rather than just saving. Last quarter, we wrote about how these accounts can amplify your returns, and I encourage you to check out our blog entitled The Eye-Opening Difference of Using Your TFSA for Investing versus Saving for more details. Turning now to the RRSP contribution limit. For 2025, the maximum amount is the lesser of 18% of last year, or 2024's earned income, or $32,490. Now, if you're unsure whether a TFSA or an RSP is right for you, check out our TFSA versus RRSP calculator to get a better idea. And for first-time homebuyers, the FHSA lets you contribute $8,000 again this year. And if you didn't contribute the maximum last year, you can carry forward unused room. And for a refresher on how this account works, see our guide to FHSAs. Also, for first-time homebuyers, you can now borrow up to $60,000 from your RSP or spousal RSP, which is a sizable increase from prior years. This means that a couple can borrow up to $120,000 for the down payment. Now, if you're a Steadyhand client, remember that you can contribute to your accounts by calling us between 7 and 5 Pacific time or 10 and 8 p.m. Eastern time. Our advisory team can help you invest funds directly from your bank account to your Steadyhand accounts. And don't worry about being put on hold. We strive to answer all of our calls within 3 rings. Now, to help us unpack the rest of the key numbers for 2025 and what they mean for Canadians that are planning for or living in retirement, I'm joined by Owen Winkelmolen, a certified financial planner and an expert in advice-only financial planning. Owen, thanks for being here.
Thanks, David. Glad to be back.
Well, let's get started with the government benefits, and we'll talk first about CPP and OAS. And what are the new limits for 2025? How have they changed from last year? And frankly, how can retirees make sure that they make the most of these programs?
Yeah, great question. So for Canada Pension Plan, if you've already started the benefit, then the Canada Pension Plan payments will go up with inflation every year. But if you haven't started that benefit yet, if you're pre-retirement or if you're retired and you haven't started CPP, then what you'll see is that that benefit has gone up based on the year's maximum pensionable earnings. So this year, the maximum for 2025 is $1,433 per month. And per year, that means $17,196 per year is the maximum CPP benefit that you would be eligible if you're starting CPP this year in 2025. This year is the final year of the CPP enhancement rollout. So this started in 2019. It's continued now until 2025. So what we'll see is that this is the final year that your CPP contributions will go up. What that means is that for the first $71,300, you'll be contributing 5.95% of your earned income. But now there's a second additional amount. That second additional amount, that's gone up to $81,200. And the difference between those two numbers, you're going to be paying 4% of that difference. So between $71,300 and $81,200. Now what that means is that your total max contribution for this year is a little over $4,400 to CPP. Now that it's an increase from last year. Last year it would have been $375 lower, but of course now you're getting the benefit of that full CPP enhancement going forward. No other big changes at the moment. As long as you've been contributing, again, you're going to get a fairly large amount. And then every year going forward, if you're earning above that new additional YMPE amount, you're going to be getting the full benefit of CPP enhancement. Now, it will take a number of years to get the full amount, but that's going to benefit everybody who hasn't retired who's still earning income.
Okay, terrific. Well, let's move to OAS, which is an important part of a retiree's annual income. It's also a little bit contentious because it has this clawback feature. So what's new for OAS in 2025?
Yeah, of course. So old age security does go up every quarter. So what we've seen is that the last quarter, we didn't see an increase in CPI versus the previous quarter. So the amount that gets paid in early 2025 will be the same as it was for the last quarter in 2024. Now that amount is $728 per month, and it's going to work out to about $8,700, $8,732 per year. Now, that amount is a 2% increase versus previous year, but it does go up every quarter with inflation, with CPI versus the previous quarter.
Can you walk us through the nature of clawbacks? You know, what level do we start to see those clawbacks? What are the clawbacks, and at what point am I 100% clawed back?
Yeah, that's a great question. So if you're a higher income retiree, you're going to experience old age security clawbacks, the old age security recovery tax. Now this year, that'll start at $93,454. So $93,454. If your taxable income is above that amount in 2025, then you're going to start experiencing a 15% recovery tax on old age security on any income above that amount. So if you are below the age of 75, that means that your old age security would be fully clawed back at $151,668. Now, if you're over the age of 75, you get a 10% bump to your old age security benefit. And that means that your old age security would only be fully clawed back if you have taxable income above $157,490. Now, these are fairly high income amounts, so we don't see most retirees hit these numbers. But if you're selling a cottage, a vacation property, a rental property, and you've started old age security, if you're triggering large capital gains or big RRSP RIF withdrawals, this can be a concern in retirement. So definitely planning ahead, avoiding those old age security clawbacks would be highly recommended.
Turning to the third leg of the government benefit stool, guaranteed income supplement, or GIS. Just before we get to that, do you know how many Canadians are taking advantage of GIS? And frankly, are as many Canadians taking advantage of it as they should be?
Yeah, it's a great question. So GIS is often thought of as an income benefit, non-taxable income benefit for lower income seniors. But the fact is almost 1 in 3 retirees over the age of 65 are receiving guaranteed income supplement. So this is a widely available benefit to many retirees in Canada. Now, the amount you receive depends on what your taxable income was in the previous tax year. So what you earned in 2024 will then impact what you receive starting in July 2025. Now, the amount that you can receive at a maximum is quite generous. So this year in 2025, it's a little over $13,000 for an individual, and for a couple, it's almost $16,000. So those amounts are quite generous at a maximum, but any sort of taxable income, whether or not that's Canada Pension Plan, RRSP RIF withdrawals, pension income, even taxable income on interest or dividends, will all reduce the GIS from the maximum. So what you'll receive is probably quite a bit lower than the maximum guaranteed income supplement benefit, but 1 in 3 retirees are receiving this in 2025.
In closing, Owen, if you could give one piece of advice to somebody that is, entering into or living in retirement for managing their finances in 2025, what would it be?
Yeah, I think it's always important to have a plan in place, a retirement plan, and to keep that plan up to date. As we just went through, tax rates change, tax rules change, legislation changes on a constant basis, and your investment returns will change. Hopefully they go up, maybe they go down, but that's always going to impact a retirement plan. So like we just talked about, there's opportunities to draw more. Maybe you want to do it for tax planning reasons. Maybe you want to spend more, that your investment balance has gone up. So when we talk about retirement planning, it's important to have a plan, but it's also important to keep that plan up to date. So retirement planning as an ongoing kind of activity will definitely help you take advantage of both your investment assets, your retirement assets, as well as any tax changes that happen year over year.
Well, and as you know, as I like to say, it's not plan the noun, it's planning the verb, which is much more of an active, ongoing activity. And certainly the work that you do in the advice-only planning community is fantastic. And the work that our advisory team here at Steadyhand do is incredibly complementary. Now, if you're still saving, what's the one thing that you should be focusing on in 2025?
Well, definitely taking advantage of the tax-free sort of savings account, the new contribution room, as well as the RRSP, taking advantage of the new limits that are existing, as well as the first home savings account. So now that we have multiple sort of tax-advantaged accounts in Canada, there is, of course, a little bit of extra complexity there, maybe a little bit of tax planning that you can do if you're still in the accumulation phase. But making sure that you're taking advantage of all of those opportunities to grow your sort of net worth, your assets on a tax-free or tax-deferred basis is going to be a big advantage as you move forward. Getting that money invested, getting that money growing tax-free or tax-deferred, and doing that on a regular basis with regular contributions and a specific plan of how much you need to contribute, that's going to make things so much easier in the future. Just regular contributions and tax planning on an ongoing basis.
Owen, thank you for joining us and lending us your expertise and insights. It's been really, really helpful. And I hope that everybody watching this video has been given some valuable insights for the year ahead. Certainly, if you have any questions or topics that you'd like us to cover beyond what we covered today, drop them in the comments below. And don't forget to like and subscribe to our channel for more helpful videos. Thank you all for watching, and Happy New Year.